Hi guys. Today we will analyze Leggett and Platt stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock's overall performance in the market is below average. Also, recent evolutions are not positive. Both the long and short-term trends are negative. It is better to avoid buying stocks with negative trends. Support level is around $36. Strong support level is around $30. Resistance levels are around $40.50 and $44. The next resistance levels are around $45 and $49.50. In the last month the stock has been trading between $34.80 and $40.50 range. It is currently trading in the middle of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.2 million. This is a good sign, as it is always nice to have a liquid stock. The stock has been falling since May 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 7% per year, for last 5 years. We see that the average profit margin of the stock has been around 7% per year, for last 5 years. Also, we see that the average free cash flow to net income rate of the stock has been around 122% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Leggett and Platt Company: bad, average, and good. First scenario. Leggett and Platt will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 6%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $31. Second scenario. Leggett and Platt will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 7%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $43. Third scenario. Leggett and Platt will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 8%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $58. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 2.94. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Leggett and Platt, analysts forecast growth rate around 4% per year in next 5 years, and future P/E around 13. Again, I will use 3 different scenarios for Leggett and Platt Company: bad, average, and good. First scenario. Leggett and Platt will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 12. In this case, the fair value of the stock today would be $15. Second scenario. Leggett and Platt will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 14. In this case, the fair value of the stock today would be $21. Third scenario. Leggett and Platt will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 16. In this case, the fair value of the stock today would be $29. As you can see, today the stock is overvalued, $37, even if we expect the company's high performance in future. The company is a dividend king. It has raised its dividend for 50 consecutive years. And its dividend yield is enticing, 4.53%. It's a well-run company with good fundamentals. And the stock is fairly valued at the moment. However, the company's future growth is limited, 4% on average over the next 5 years, and the stock has been falling since May 2021. I will buy the stock just for the dividend when I see the stock's bullish reversal. Company's strengths. Leggett and Platt designs, manufactures, and markets engineered components and products worldwide. It operates through 3 segments: bedding products, specialized products, and furniture, flooring and textile products. It provides seat suspension systems, motors, actuators, cables, engineered hydraulic cylinders and other equipment. The company was founded in 1883 and is based in Missouri. It has built a culture among distributor and dealers where the dealers not only promote company's products but also invest in training the sales team to explain to the customer how to extract the maximum benefits out of the products. The company has built expertise at entering new markets and making success of them. It has a strong base of reliable supplier of raw material, thus enabling the company to overcome any supply chain bottlenecks. Successful track record of integrating complementary firms through mergers and acquisition. The company is a dividend king. It has raised its dividend for 50 consecutive years. The company has a yearly dividend yield of 4.53%, which is a nice return. Risks. High attrition rate in workforce. So, the company has to spend a lot more compared to its competitors on training and development of its employees. Not very good at product demand forecasting, leading to higher rate of missed opportunities compared to its competitors. There are gaps in the product range sold by the company. This lack of choice can give a new competitor a foothold in the market. The current asset ratio and liquid asset ratios suggest that the company can use the cash more efficiently than what it is doing at present. The company needs to put more money in technology to integrate the processes across the board. Right now the investment in technologies is not at par with the vision of the company. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow only by 4% on average per year. The earnings per share is expected to grow only by 6% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.